Trump's tax plan is really big for businesses. And that's going to be a big smack in the face to a ton of business owners. We're talking thousands and thousands of dollars of additional tax. Let's kind of set the stage here.
What is it?
Huge. Everybody's going to want to work overtime, and you got to pay that at time and a half.
Yep.
So that could cost your business a lot of money. I think it's just going to really make a shift.
Hey, everybody, and welcome to another episode of the Next Gen Strategies podcast. I'm back doing the introductions this time because we didn't screw up 8 different times like we did on the last episode.
He's been practicing.
I've been doing really, really well. So today we have a really good episode. There's been a lot happening over the last couple of weeks, and we're going to have a new president getting installed. So I think now would be a really, really good time. And we were going to do this regardless of who got in, but I think now would be a really, really good time to talk about what some of the implications might be for business owners as it relates to the different tax laws that are going to be coming in with the Trump tax strategy. So we want to cover a couple different things today. And, luckily we are, we're graced with the presence of a CPA. So we're going to keep it very applicable and high level, but there's some really, really important things that I think we should be covering as we talk about next year. And Tyler, I'll let you kind of discuss a little bit what we want to talk about today.
Yeah, the dust is settled, and we do have a president coming up, and each president had their own tax plan. So I think that's what we're really going to be talking about here is Trump's tax plan. It doesn't mean that his tax plan is going to go into effect just because he's president. There are some things in there probably that can go into effect because he's president, but there's also stuff that has to be passed by, Congress and into law. But I think it's really important for us to touch on the impact of Trump's tax plan and what it means to businesses. So, the big thing I just want to say here is that, Trump's tax plan is really big for businesses. It's just got a lot of impact, and there's some things we really need to touch on that you need to be aware of moving forward over the next couple of years. So I kind of wanted to start with one, and this one's kind of funny because I don't know, it was probably a month ago in passing, I said something about it to Grant. And the first one is it's called the 199A deduction. Most people call it QBI, called Qualified Business Income Deduction. That one is huge. So let's kind of set the stage here.
What is it?
Huge.
No. Sorry.
That's really funny. But it's really big. So back when the tax plan that Trump put together passed in 2016, 2017, part of that was this new deduction. And what it is basically the net income of a business, right? You get a 20% deduction of what the net income of the business is on your tax return. Big, right? So you're talking if you had $100,000 of net profit, you're getting a additional $20,000 deduction, and you're going to pay tax on $80,000 of profit. The reason I wanted to bring this up is, and we talked about this before, as a CPA, I'm like, oh yeah, this ends in 2026. Everybody should know that. Well, not everybody actually knows that this sunsets. 2025 is the last year. 2026 rolls around. That's gone. So if that happens, and that's going to be a big smack in the face to a ton of business owners. We're talking thousands and thousands of dollars of additional tax. If the tax law that Trump passed in his previous presidency does not get extended. There are parts of that tax law that were permanent, and there are parts that were temporary until 2026. So I think that, for the most part, the business owners that are seeing huge benefits here are those, we call them pass-through entities. Anybody who's running, their business as an LLC or an S Corp, they're seeing that pass through come to them, and they're getting that qualified business income deduction. Trump is saying in his tax plan that he wants to make the provisions in his original tax law permanent. So that's a big deal. So if he's able to get the law passed to make the QBI deduction permanent, as we prepare taxes now, will remain until law gets changed again. If he's not able to make that permanent in 2026, you're going to lose whatever your net income is, a 20% deduction, which is a lot. Just want to remind people it's pretty big.
Yeah. And one of the things, not to digress too much, but one of the things you often heard during like the campaigns and everything was they talk about, the corporate tax breaks and these big things. And a lot of times folks think about like, oh, well, they're talking about the Apples and the Googles and these absolutely giant corporations. And what they don't realize is, I think the figure is somewhere around like 60% of folks who are employed in the U.S. Would be considered like a small business or something to that effect. So like this is affecting, not even just to give perspective too. Like if you work for a small business, so I just thought about that as you're talking about that. It's like, this is very, very important for those who own the businesses and those business leaders making key decisions or partners. But like understand the implications to you as an employee. That there may hopefully there's still more, but like if that tax break doesn't happen, like understand that your business has to make different decisions potentially one way or the other based on this tax being available. So it doesn't just affect, I just want to say it doesn't just affect the business leaders and the owners themselves. It's going to affect everybody within the business because tax has such a huge implication all the way around. Yeah,
I didn't even think about that. It's a really good point. I mean, we sat through a couple of economic development things just where we're at locally, and there's a striking high level percentage of small business employers and what percentage they make up of the total amount of employed people or just GDP. Yeah, GDP, but the employed people where you're
correct.
at. Yep. So it's not, you run into some areas where, GE employs most of the people there or something like that. But in a lot of places, small businesses are literally the backbone to the entire economy.
Yep.
So this is important for business owners. Don't get us wrong. And that's where we're bringing it to you. But yes, it trickles down and it affects the employees in a big way.
Yep.
And this is one of the biggest ones. Like when I talk to business owners, I always tell them when we do tax returns that you're getting an awesome tax deduction just for having a business. That's what this is. And that's what it was really designed for, because there are actually income phase outs on this. And it is designed to hit like the average small business in a big way.
Mm-hmm.
So QBI was a big one. I just wanted to make sure I covered that off the top. There's also one that's kind of equally as big too. It's another one that's called bonus depreciation. So I don't want to make this podcast this big tax geek out thing, but people don't know this, but a lot of times, like if you spend money on something in your business, particularly like an asset or a piece of equipment, you don't necessarily get to deduct the entire cost of that piece of equipment in the year that you bought it. Normally with tax law, you have to depreciate it over a period of time. And depreciation just means, we look in the books, the tax laws, and we say, oh, this forklift tax laws say it needs written off over 5 years. So you get a chunk of the purchase price every year for 5 years. What something like bonus depreciation does is it allows you to elect to take the entire purchase price as a deduction in the year that you bought something. And why that's important is because like this time of the year, late in the year, business owners will look at how their business is doing and say, well, I certainly need this piece of equipment. Now might be a really good time for me to buy it. I will elect to basically deduct the entire cost of this right now so that I'm paying a little bit less on taxes. And it doesn't matter how you buy it. You could buy it in cash. You could put it on a credit card. You could go get financing at the bank. You're still eligible to take the entire cost as a deduction. Well, that has been phasing down over the last couple of years as part of the TCJA tax laws. So in 2024, it's 60%. You're able to deduct up to 60% of the purchase price. It goes down to 40% in 2025, and then down another 20%. In Trump's tax plan right now, what he wants to do is bring that back to 100% and keep that permanently. So that, at the end of the day, it's not necessarily making you have more deductions, but it's allowing you to have timing and decision-making at your side to determine if you want to go ahead and deduct all the cost of a big purchase, in the year you bought it because you had a great year, income-wise. So,
and I think, and to that point, I think you would also say this too, being a CPA, like, just because you can do something doesn't mean that you should necessarily do it. And there can be a lot of bad that potentially happens if you don't have the right strategies in place and have the right professionals. So I'll go ahead and throw that as a marketing guy. I'm going to throw that disclosure out on your behalf.
Yeah.
Just because it's 100% doesn't mean you should be taking 100%, but to have that option and that flexibility, I think is what you're getting at, to say like that makes a big difference when you need to be able to be very strategic with your tax planning.
Yeah, obviously, you know, as a disclaimer, none of this is tax advice for you, but anytime we have the ability to have flexibility with the tax code, we want it, because it lets you make business decisions in different ways depending on your situation.
Yep.
And that I think the bonus depreciation item coming back to 100% is really important for business owners to be able to make decisions for cash flow purposes. And when I say cash flow, it's because you got a tax bill coming. Businesses go in cycles, this and that, you know, it's really great to be able to have that flexibility. Mm-hmm. So that is the bonus depreciation piece. I wanted to touch on that, and excuse me here, because this is tax stuff. So I got this on paper. I'm not going straight out of the memory bank.
We're not going straight from memory on this one.
This one is not necessarily the most major thing we're going to talk about in terms of Trump's tax plans, but it's an important piece to touch on that everyone forgets. Is before 2016, the old tax law that we were operating on, there were some components on your individual taxes that were important that rolled into this new tax plan. Before, I don't know if you know much about it, but you would get a standard deduction. So what a standard deduction is when you get to write off a chunk of basically dollars off of your taxable income to determine what your actual taxes are. Before, the standard deduction was pretty small, and then you would get these little bonus exemption amounts for dependents you had. And that's important because it actually made a lot of taxpayers have to itemize, because they would have things like mortgage interest or healthcare costs or donations or this or that were higher than the standard deduction. So they would itemize. And what it would do is it would complicate their tax return.
Right.
So one of the things Trump was thinking about when they did this tax law was, how can we make tax returns more simple for average taxpayers? So they dramatically increased the standard deduction to make it to where like most taxpayers don't itemize at all, and they use that standard deduction. If the phase out happens and it's not extended, we're going to go back to the old way we do taxes, which means you might have to start keeping all those receipts again and starting to do itemization. It's more complicated, this and that.
Well, so on that piece, what do you remember? What is it now? What would it potentially revert back to?
So right now it's at like 29 for 2024. It's going to be 29,000 and some change for a married couple, and somewhere around $14,000 for a individual. And before, it was like 12,700 or so for a married couple, and like $6,300 for an individual. It's a big number.
You're halving it, over halving it potentially.
Yeah. Now, if you had several kids, you would see your tax situation didn't change a ton, but it's really big for somebody who doesn't have dependents.
Right.
Like you're making out a lot with this new tax law when you don't have a lot of dependents, because you're just going ahead and getting that big standard deduction. So that's something that's really important, because it just changes the whole tax landscape for, business owners are individuals too. So it flows down to their actual tax return. And another piece too is that while they did that, they actually also decreased the actual income tax rates on the brackets on an average of somewhere between 2% and 3% per bracket. So same thing, if the tax law sunsets, we go back to the higher tax rates, which is 39.6% at the top and 15% at the bottom, where right now we're at 12% at the bottom and 37% at the top. So, doesn't sound like a ton of percentage points, but I'll take it anywhere I can get it, you know? So they kind of compound, like these things keep coming up. It was a advantageous tax bill for most individuals and small business owners, and primarily small business owners. It was really good. So that's why we're talking about these things, because it's going to be kind of down to the wire when, this takes the whole political process for these tax laws to get in place. So it's something to really pay attention to. And if it does sunset, you need to know what might happen. You might need to prepare that you might need to be paying more taxes at tax time if it does sunset. Mm-hmm. So, the other thing that's a little bit more especially bigger business focus that we were going to get into is the corporate tax rates. So TCJA, which is the acronym for his tax law back in 2016, slashed the corporate tax rate. It brought it down to 21% for corporations. And primarily that's C corporations, technicality, but we won't get into that. So it was much higher before. I believe it was around 35%. So that is one of the components of the law that's permanent. So we're still sticking to 21%, but Trump is proposing a significant item in this. He wants to drop it to 20%. So 1% isn't huge, but it's something to note. But the part that's a little bit more significant is that he would like to drop that corporate tax rate to 15% for businesses that produce goods in the United States. Mm-hmm. So that's pretty significant. That plays into business decisions for corporations in terms of, well, if a lot of our business components are built here in the United States, that is a 6% tax reduction. And I think that also kind of lays over into the tariff section, and we're going to get to that right at the end, but it's one of those things that kind of influences maybe where things are produced.
So question on that then. So like that's kind of an easy, like cut and dry thing if I'm creating a product or I'm building a product or something. So what does what does that mean for like a service-based business? Like, does that mean, because like if whatever you're making is like more of it's like human capital. Like what does that mean for somebody like that? I'll go ahead and put you on the spot with that question. You're welcome.
Well, I kind of can defer because like we don't have the law, right? So we don't know, but I do know that they're trying to leverage the program that's called, the acronym is DPAD, DPAD, domestically produced something like that. There are a lot of technicalities to DPAD, because clearly a lot of, I'll get to the service base, but like manufacturers, they may not make everything in America. So like there's a lot of calculations and theory that go into it. Clearly, if you're one of those people, you have to talk to a good CPA, but you'll be able to be guided to making a good business decision for that reduction in tax. I don't think there's a lot of provisions really there for service-based businesses. And typically you're, outside of tech, your big, where these tax cuts matter are for very large businesses. And a lot of those are your producers and manufacturers. So that's a piece I, don't necessarily know now because we just don't have the provisions and we don't know how they're going to change them. Mm-hmm. But it's possible you see something there because that's a big thing we're seeing now. I see it in my field a ton, is that there is a lot of offshore labor.
Yep.
That is absolutely something that could be snuck into these bills because, realistically, offshore labor is not a whole lot different than getting your product from overseas as well. Right. And it influences the labor market in the United States. Big, giant accounting firms, they offshore a ton of labor.
Yeah. And I think one of the things to consider too is not just if you're one of those businesses that are making one of these decisions around like, okay, what are we going to do here? That may present potentially unique opportunities for entrepreneurs who might be looking to start a business or do something different. Or maybe you're a very small business who supplies a different type, a larger business. Like you should be aware from, kind of watching where these tax laws and stuff going, because if the government is looking to incentivize domestic made product in the US and you're somebody who's maybe already doing some supplying to certain manufacturers, or, that you've always lost in price to somebody who's overseas, this may present to you an opportunity, and I'm going to put my marketing hat on, right, to say, now you maybe got a little bit unique value proposition. I think, and you mentioned, we'll talk about tariffs here in a second, but one of the things that happened kind of coming out of COVID was this reshoring effort of, just from a reliability component in the supply chain, people wanted to make sure that they had stuff that was closer to home. They weren't so dependent on things that were necessarily overseas or in a different, country. And so I think that did accelerate a little bit of what was happening in the US. But now if you've got still, which I think some of that is still happening, I know some is still happening, now you've even got another potential opportunity to where like, hey, not only is there the reliability factor of a US made good, but now you're also going to have, there's tax implications to and cost implications. Yeah.
And it's important to understand that none of these provisions are kind of in a silo. Mm-hmm. I've said this before, and a lot of CPAs say this, like the tax laws, for the most part, especially as they relate to business, is a way for the government to incentivize what they want to see happen in the U.S. economy.
Right.
That's why that's why real estate has advantageous, tax benefits, because the government wants to see investment in real estate, because real estate's really important for the average citizen.
Right.
So you're going to see this across the board in both income tax, tariffs, overall just policy decisions, how those things can kind of all work together to naturally incentivize in the free market how goods and services are provided in the United States. So, and we'll try to pull that again full circle when we get to tariffs. I do have another one that's kind of a smaller one, but I remember back when the tax law that we're currently operating in was passed, one issue was, it's called SALT, which that's state and local taxes. So part of the package that Trump put together was he was trying to basically disincentivize the states that have really high local taxes. And a way to do that was he was saying, hey, normally you can deduct your property taxes, state taxes, and like city and township taxes, whatever the taxes you pay locally on your federal tax return. And he put a cap on that of $10,000, which made for some people, after the tax law went into place, if you were in a high tax place, state or locally, you could have seen a higher overall or an effective tax rate because of that, because you were itemizing and deducting significant amounts of property taxes and local taxes and state taxes. He is saying that he wants to eliminate that provision with the new set of tax laws. So that's going to be really beneficial to those of you that are living in those high tax states and make your tax situation much more efficient. So I thought that was really important to add here, because that was one of the main gripes of his tax plan. Because if you were in a high tax area, you just lost a lot of those benefits. So I wanted to put that in there, because he is saying he kind of wants to reel that back. And then we have what I think is one of the big ones, and one of the big ones that maybe business owners aren't really thinking about as much as individuals are thinking about.
Which the individuals are thinking about it.
Yeah. So Trump's talking about eliminating income tax on, overtime pay, tips, and Social Security income for the retired and disabled. That is a big deal. That's a big deal to individuals, right? That's a big deal to retirees and in the disabled community, as well as all those blue collar workers out there working overtime. It's huge. And all of our hospitality workers that are grinding it out every day. But for you guys, business owners, this is a big deal, because you're talking about this could just completely change the landscape of labor. You could see, you're talking no tips would be taxed. I'm going to assume we're going to see, if that happens, an influx of people into the hospitality space, because look at this. I can go work weekends at the local bar or restaurant, and all the tip money I make goes right into my pocket. That's a big deal. And that's you're talking, that could be an unlimited labor force, because these people they could be stay-at-home moms. They could already have a full-time job, but they just want to make a little bit extra money. Talk about the pressure right now. Restaurants have, and the entire hospitality space of finding staff. This could be huge for them.
Yeah. That one's huge.
Yeah, huge again. But then that leads right back into overtime, right? You're talking basically every blue collar worker across the United States, has access to or has worked a lot of overtime. And the number one complaint you're going to hear from them is, if I work overtime, I'm going to be taxed to death and it's not really worth it. Can you imagine the amount of willingness to work overtime knowing you're making time and a half or double time without any federal income taxes?
And one thing about that, so I want to ask you about this. I'll put you on the spot again. So how does that correlate, or what would you think about, because they just upped the salary thresholds for what you can consider somebody's salary versus hourly, or salary versus hourly. So there's kind of that piece going on. And then you've got so I know like some businesses I've talked to, they're like, well, yeah, we're going to have to kick, we just can't necessarily afford to kick everybody up to that, that automatic, whatever, 56,000 minimum threshold to call somebody salary. So you could potentially have, if I'm thinking through this correctly, you could potentially have more workers on an hourly rate who were working more hours than 40 anyways. Like I just thought about that. Like there could be some more implications on that side of things.
This is complicated because, and I'm going to say this though, and I have no facts to back it up. So, roast me for that. But I'm going to say by and far, most people who are at that point where they're going to go ahead and they were exempt before, they were salaried people with not access to overtime. Right. And now the new salary threshold is not attainable for that business, that group and pocket of people. By far and large, those are not the blue collar overtime working people for the most part. A lot of times they are administrative in nature.
Yeah.
Tons of nonprofits, tons of people who are working in the office of these establishments. So, while I do know that a lot of those people work over 40 hours, I think the target of this tax-free overtime is at those kind of the people on the ground level who are the production people. Yeah. I think it's complicated because, businesses are going to have to look at this two different ways, right? One, it's going to be fantastic for the eagerness of employees to want to work overtime. So if you have that problem where it's like, man, we have to hire because we can't get the guys to put in an extra 10 hours of overtime, that's going to help.
Right.
But at the same time, what you're going to have to watch out for is everybody's going to want to work overtime, and you got to pay that at time and a half.
Yep.
So that could cost your business a lot of money. So you're going to have to understand the weight between hiring additional people versus overtime. But we know in this labor, market, it's really hard to hire people. So I don't necessarily have the answer for business owners who have those individuals who they're going to really struggle to get them to the new exempt rate. But I'm going to probably suggest if you think they actually are working a lot of overtime, it's probably going to be worth it to get them there because that time if they work some overtime and you got to pay them time and a half, they're going to be there anyhow to a certain extent. But I'm kind of mainly focusing on those like construction and manufacturing, like in contractors where if you don't have to make that additional hire because everyone's willing to work that extra 10 hours a week, that could be pretty big. It's going to cost you a little bit more, but the employee is going to feel all of the benefit from it, which is, I think it's just going to really make a shift. Another thing it's going to make a shift on is think about all the hospitality industry where a lot, minimum wage for tipped workers is lower, but you see a lot of them that actually pay higher than that. It might incentivize all the employers to pay the minimum again and really try to encourage more tipping because that's better for the employee.
Which will be an interesting thing from a marketing standpoint or a service standpoint of how do you go about that?
Yeah, because, tipping culture is a thing that, people, that's a hot button issue, right?
We might just have a podcast on the people who flip the screens back to you sometimes. So anyway.
But what is this going to do though? If this goes into effect, it's going to enhance the tipping culture. It's going to make it dramatically higher because these employees are going to get that tax free. So that's going to be interesting as well to kind of see how that plays out. But it's really something you should have your kind of you should have the beat of that as it develops as a business owner, because that's going to change the dynamic. And you got to be on your toes, because if you're sitting back on your heels on this and your competitor or another employer figures out the best way to do it before you're going to lose employees.
Yep.
So it's something that's really important.
Yep.
Then we get to tariffs. So tariffs will be interesting because I think there's a lot more ability for the president to impact tariffs in an easier way for them rather than have to go through the laborious process of, the Senate and the House for tax law. So right now, Trump is suggesting he wants to do somewhere between a 10 and 20% flatline tariff on anything brought into our country from any country. So if you get into tariffs, it's incredibly complicated, because you will have the steel industry will have different tariffs than this or that, and every country's got a multitude of different tariffs on all the different products. But if he's saying, because there are a lot that's free trade, right? There's no tariffs, and there's some that are really high. But if you're talking all the zeros are coming up to 10 to 20%, that's impactful. Then the other one that's very impactful is that he's talking about taking basically flatline anything coming from China into the United States is at 60%. Part of why he's suggesting this, it's kind of a multitude of reasons, but on the face of it, one is to try to pay for the tax cuts. tax cuts have to be paid for in some way by either reducing federal expenditures or finding tax dollars somewhere else. So I think this is a component of, okay, if we increase the tariffs and the trade continues at some amount of level that's comparable to where we're at, that's going to compensate for a lot of the tax cuts. And then also clearly he's got this long-term vision, I would assume, of that this is combined with some of the things we talked about before, like the 15% rate for domestically produced products. This is going to encourage our market to produce our goods in the United States. But this is one that, go ahead.
No, I was saying, and I'll add just one more to that too. I mean, it was just specifically on the China thing. I mean, it's no secret. Like they've been trying to produce the same goods as the U.S., but they charge less, right? And so from a competitive trade standpoint, like, he's trying to even out that playing field a little bit as well, and raise the just try to even that playing field out from that standpoint too, because of labor costs and competitive and intellectual property. Like there's a lot of things that go into that as well.
The intellectual property thing's a big piece too. And for the listeners that don't know, you've probably bought a clone or a fake of something in your lifetime that came from China, right? So like they don't have the same, business owners don't have the same product, in the United States, if you patent something or you get a trademark on something, like you were protected from competitors making that.
Correct.
But it's really hard to stop that from happening if it's produced in China then brought over here, so it's really tough for a lot of business owners. But, I think the thing that we have to think about is that if this happens, you got to take a hard look at your supply chain, because you probably have a lot of your supply chain coming from China. Or, 10 to 20% is no joke in other countries, including Mexico and things like that. This could usually what happens is, tariffs can almost be kind of similar to a sales tax, because like the consumers are going to pay for it. Because if we throw a 60% tariff on a product coming from China, that means the cost needs to go up 60%. That's just what happens, right? You're going to have to make a business decision on if you're still willing to pay for that product that's coming from China at a 60% higher rate. But what this inherently should do is make you start thinking about, okay, what in my supply chain do I have that's coming from China? And is it produced in the United States? And who are those suppliers? And maybe I should start talking to them to see what their costs are, or you may already know what their costs are. And it might influence your business decisions on where you're sourcing these things. That's the moment that's introduced is going to have it could have like a wildfire effect. And it really can push down the consumers and increase prices until we reevaluate how we're doing things. And I'm going to go on a mild tangent just because I have this problem myself too, but like we're addicted to cheap goods. That's the thing that's happened in the last, 30 years that never occurred before, is that you can go out on Amazon or go wherever, Walmart, and get a product for very, very cheap that in 1970 you would have paid, in real dollars, 5 times more for it because it was produced here and it was a higher quality product. We are always looking for that thing that, we can get super cheap and that might be a culture shift that we have to get used to. If the cheap good all of a sudden now is close to the cost of that higher quality domestically produced product. And that might be a pain point for some people because we've gotten so used to being able to get things so discounted.
Yeah, for sure.
So, that's the tariffs piece. I think I've hit most of the things in this plan. But I did want to kind of do some key takeaways from this because, while a lot of this is really impactful, like it is just because he's the president now or going to be the president does not mean that it's happening right away or promise that it will happen. If you look back at when his first tax law got put in place, like it was no easy journey by any means. There was a Republican-controlled House, a Republican-controlled Senate, and then clearly he was the president, and it passed by slim margins. And it passed like at the midnight hour. So we talked about this, right? So we're going to go through 2025 with the current tax laws, and then 2026 is a sunset. We could be late into 2026 before anything happens, if anything happens. So you're really going to have to kind of pay attention to what's going on and talk to the professionals in your life, like your CPA, about your business decisions based on what's going on. And you may not be able to make a lot of strong decisions because it could get signed at midnight right before a government shuts down. Who knows, right? But I think there's some things, and maybe Grant, you can talk about this too, even from the marketing perspective, that we could be doing in the back end, especially as it relates to like the tariffs thing, or the employee related stuff with Social Security and overtime and tips, that may position ourselves to like act a little quicker if it does happen.
Mm-hmm. Yeah, no, I think it really becomes down to a messaging standpoint, and we've probably talked about this on some of the other podcasts too. Just being ready to talk to, if you need to push quality at times or value at times or price comparisons, like just kind of be ready with some of those different things from a marketing standpoint, because based off of what happens from a competitive standpoint, like, you just got to kind of know where your products and services are going to line up and fit in the market, and be able to kind of adjust to where things are going and put yourself in the and really it's putting yourself in the head of the end consumer and just kind of knowing from a market standpoint where you want to go. So
now that you've kind of heard me talk about this, like maybe we could break this down from your perspective. So maybe give like the listeners and me your perspective of a business, specifically probably someone who's like a manufacturer or a producer, that like the differences and what you would be thinking about if you were a business that primarily produces in the United States, and maybe what competitive advantages you have versus, what you should be thinking about if you source everything overseas. Yeah, I'll start with the first one. Yeah, basically, so if you're somebody who's, I'm gonna call it the everything made in America 100% kind of type of business, one of the things that you're often competing against, you're gonna be competing against the folks who maybe are getting in goods who are coming in from overseas, China, wherever. And so oftentimes you're competing because you're looking at it's gonna be price, right? So your goods, typically what happens with, if you're 100% American made, is like, well, you're usually a higher price because your competitor is sourcing from overseas. And so you're oftentimes trying to speak more to the value of your product. What all do you get with it? Is there a reliability component? Is the quality last 10 years versus your competitor that lasts 5 years? And so from a marketing standpoint, those are the different things that you're often going after. Well, now if something shifts and you see the price start to kind of come more of the same, it's just going to be interesting, because you're going to have to watch, because your competitors who are going to potentially have to make a change with their messaging. And so you need to then be able to really be ready to strongly compare, because the playing field's evened out. And so they may be talking now more to something different. So just be ready for that, I think is my biggest recommendation there. And I would think too, like if you're producing primarily in the United States, like you could use this as a huge advantage. Even like I already put the warning out that who knows if and when this will happen. Right. But you could start, we just had a episode about partnerships, but like you could start expanding your reach to some of the target customers that maybe you were never able to land, and say, hey, we're going to be positioned really well to supply you, if these things happen. And you might be able to get somebody converted just based on their thoughts of like, well, this is going to happen and I want to be prepared for it. Or then you're just sitting there primed and ready for when it does. Yeah. I would think that's a huge competitive advantage. But if you're sleeping on it, you probably should start getting out there and making those connections. And I think a lot of times, and we're seeing this even generationally too, like a lot of people I feel like it's changing. People used to be so much more fixated on price, and now it's so much more on reliability. And I think that the more that you can push reliability and consistency and product quality, versus even like the price argument, I think it's going to be huge. And so just making sure that you're ready to, we both like sports, right? So it's like you read the scouting report, what do they do well? What do they not do well? How do we position ourselves? Like it is the same thing in business. And so, that the messaging, the storytelling, don't be afraid to do direct comparisons. Like, I finally, and I've been making this recommendation before, like, if you know that there's only one other competitor to you or two other competitors to you, like directly put that in your marketing. Like you might want to say like, if you're Apple, like, okay, for example, Apple and Samsung, like
not a whole lot of competition in the cell phone market. And so you oftentimes, or your Verizon, AT&T.
Yeah.
So like, go right out and say like, look, you might be a good fit for us if you like this and this, and you might be a good fit for them if you do this and this. So again, just different ways to think about that.
Yeah. I mean, you could be like, hey, we produce entirely domestically. We will see very little price increases. There's so many different angles you could think about. And then if you're that business owner that has some key components coming from China, I think it's a time to really start reaching out and seeing what the domestic vendors are doing and how you may be able to wrap that into your product or your delivery. I mean, that's going to be a big change for you, but it's something that you don't have to do overnight, but you should start probably preparing for in anticipation of potentially those cost changes. Just to add some funny stuff to this, this reminds me of, and I don't know if you've ever seen it or if you watch it very much, but The Office, there's a scene where Dwight and Jim are trying to sell their paper to this.
I know.
They're trying to sell their paper to one of these clients, right? Yep. And they just got undercut on price significantly. Yep. He's like, I don't know what to tell you. They're just so much cheaper, this and that. And he said, well, Jim's like, why don't, or not Jim, but Dwight says, why don't we call our competitor right now? And they call and it's like, do, hold. It's a call center music. Just never get to anybody. He goes, why don't you call our office? And immediately somebody picks up and says, oh, hi, this is, Dunder Mifflin Paper Company. What do you need? And that's what sold the deal. And I think that's one of these things that you might be able to take advantage of. Like when you're talking quality and customer service and these things, like it just reminds me of that episode and how maybe price isn't the end all be all in a lot of industries. And then the other caveat I'll add is that both myself and Grant are, all of our services are placed here locally in the United States. So we should be in good shape too, right?
I don't know why I hesitate. I'm like, yes.
But we might buy a product or two from.
That is software. There might be software that's not.
But we're here.
We're here.
Unless we're on vacation.
Yeah, right. But there you go.
But that's pretty much a wrap. Do you want to send it off for us?
Just a lot of things we discussed today, and this is definitely a bit longer episode, but I think it's definitely timely because of all the things that are happening, especially with, this is going to drop around the time people have either more likely have finished up some of their strategic planning going into 2025, unless you're one of the procrastinators. Just a lot of things to consider from the tariff situation to individually from a tax perspective to if you're a corporation, what are things to consider, and supply chain logistics, all things in between. So continue watching, continue kind of following along, and we'll see kind of where we end up in the next couple of years and as things change. So hope you guys enjoyed this episode. And as always, follow along with us, subscribe, like, share with your friends. And until next time, we'll see you later. Thanks again for joining us today on the Next Gen Strategies podcast.
Be sure to follow the show on Apple Podcasts, Spotify, or wherever you get your podcasts.
And if you really enjoyed it, give us a share on any of your favorite social media channels.
And don't forget to leave us a review.